Hewlett Packard's down more than 10% today following their earnings release today. Investors are really concerned about the prospects of the falling revenue from Hewlett Packard due to the softening of the PC market. It was expected, but I guess when investors see the numbers, it really hits home. I wanted to take a look at this company. It's a company that's been respected for many years, and it's a really solid stock, in my opinion. But I've got to take a look at the numbers, run them through my process, run the calculations to see where I think the company is valued now that they're expecting to make less money in the current fiscal year. Let me take a look at this company. Before I do so, do me a big favor and like my video and subscribe to my channel. I'd really appreciate that. Now let me take you through my process and evaluate Hewlett Packard to see if I want to buy, hold, or sell this stock. So as an active value investor, I've developed a process for myself that involves 4 key questions that enable me to evaluate a company and then make a decision whether I want to buy, hold, or sell. First, do I want to be part owner in the company, and do I like the industry? 2, is the company operating and performing well? And that's really a scorecard on the management team. Is debt less than 3 times EBITDA and therefore under control? And I want to discount on the stock. That way I can see my hard-earned money go up in value. And based on the answers to those questions, I buy, hold, or sell this stock. Hewlett Packard's been around for a long time, and they are an American success story. A long time ago, they were creating high-tech products before we even had a high-tech industry. It's pretty incredible to imagine that in the 30s, 40s, 50s, a couple guys started a company. I believe they rented a garage and started making these products that were high-tech. And over the years, they continued to innovate, come out with calculators that were just so useful to students and professionals. And then they got into the PC business as well as the printer business. They're also in a variety of consumer products like tablets and so forth. And the Hewlett Packard we know today, this specific company, really provides a lot of consumer products in the form of high technology products. I really like the company. I think it's compared to an Apple, which is at $3 trillion or less than 3 trillion, but close to it in valuation. This one's way lower. So it's easy to get into Hewlett Packard and be a significant stockholder. So I like the company. I like the industry. You know, high tech's always good to be in. You just need to be careful on your acquisition price. And I try to be careful on the prices I pay for Hewlett Packard. But overall, I like the company. I like the industry. I looked at the earnings before I saw the stock drop, and I try to do that. That way I'm not influenced by the market, you know, moving in one direction or the other. And I could tell you that I thought the earnings were just fine. We were expecting that earnings per share, it actually beat on earnings per share. They came in a little higher than what was expected. So that was good. The previous outlook was 81 to 91 cents. They came in at 86 cents. So that was good. The revenue's down basically 10% year over year. That was expected. I mean, they've been on a reducing revenue for several quarters. That was expected because during the COVID years, a lot of people bought new PCs. So the demand for PCs right now is soft. And as you know, people wear out their PCs, break them, drop them, spill milk on them, they're going to need to buy PCs. So they're going to have to wait for the next PC refresh, both from consumers as well as businesses. And I think that's what's ailing the company with this earnings releases. It just really hit hard on some investors seeing that revenue go down. Free cash flow was good in the quarter, but as I'll show a little later, they're still lagging behind the previous year. So that's a little bit of a concern. The company does do a really good job of returning dividends as well as buying back shares of stock, which is really good. And they retired some debt, which is also good news. But overall, I think that revenue drop is worrying, as well as the guidance. The guidance for the next quarter is that there is going to be more revenue loss in the quarter, which is a concern for investors. The company, if you look at historic numbers, they haven't grown a whole lot. Back in 2018, they were about a $58 billion company, and they were pretty much flat going into 2019. And they actually lost some revenue, and I think this was pandemic driven. Then they bounced back and had some pretty good growth. They grew at about 10% clip, and that's where I'm thinking there was a lot of demand for PCs because everybody was at home on Zoom, kids were going to school on Zoom and so forth. And they were able to, kind of maintain that revenue at a flat perspective, but now they're beginning to drop. That's was expected, and this is a pretty big company. So I'm expecting that, yeah, they're going to have a down year for 2023, but I think in 2024 they'll begin to see some growth, and then 2025 they'll see more growth. The balance sheet's in good shape. I already took a look at the total debt is 9.7 billion, but they produce a lot of EBITDA, $6 billion. So basically it's a 1.6 debt to EBITDA. So that's a very good ratio and a very healthy balance sheet. Now the guidance may be another reason why investors are kind of freaking out. And the reason for it is they're providing the full year guidance down here, and that is lower than what was expected for the year. I think this is below the lower range that they had guided before. I think it was at 3.5 or 3.6, $3.50 or $3.60. So they're guiding lower, and I think once you begin to guide lower, it's kind of a slippery slope, and investors get really nervous. Again, I have a lot of I think belief in Hewlett Packard. They're a solid company. So I get it, it's a lower number, but I'm not too worried about it as long as this is, the bad year, and then next year they recover and have a higher profitability and a higher earnings per share. The statement of cash flows, this is where I also saw a little bit of a concern. They are tracking, like right now, they have a little over $1.1 billion in free cash flow, and you're 9 months into the year. Last year, they were roughly at $1.9 billion in free cash flow. They were guiding earlier in the year to be at like over $3 billion in free cash flow. I believe it was 3.5. But now I'm thinking I don't know how they're going to get there. So I'm actually going to use a lower free cash flow number than they had guided before, and I'm going to use a lower number. And again, one more miss on the guidance. So I think that's the combination that's really snowballing and creating that 10% drop in Hewlett Packard. So I believe that Hewlett Packard stock is fairly priced, or you could say that it has a very tiny discount currently. And what that means is that I think based on free cash flows as well as earnings per share, you could say that the stock is worth $28.89. But right now, based on the after hours pricing, each share is worth $28 a share. So I would call that just fairly priced. My calculations on free cash flow, I took the guidance that they offered up for the full fiscal 2023 and only took 70% of that guidance, since they are missing guidance. And I looked at their first 9 months of free cash flow. I'm expecting they're going to get to about $2.2 billion. Then I'm going to grow those cash flows in the first couple of years by 2%. And then terminal value is achieved by growing long-term free cash flows by 2%. When I take all those cash flows and discount them by 8%, which is a weighted average cost of capital, this is a quality company with a good balance sheet, I get $35.6 billion. I'm going to add the cash on the balance sheet and take away the debt, and I get to $27.7 billion as the equity value. But the market cap, based on the new price of $28 a share, is going to be about $28 billion. So you actually are paying a slight premium if you look at the free cash flow method. What that means is you're paying $28, for a share that is worth $27.80. So you would kind of be giving away 20 cents per share. Now the earnings per share method kind of gives you a little bit better number. Earnings per share expected, based on my calculations, to be $3.20. Their PE is 12, growth rate of 2%. And based on this calculation that really values the company based on earnings per share, it calculates that each share is worth $31 based on that method. Shares will be priced at $28 per share, so it offers up a discount of 11%. I put more weight into the free cash flow method. It represents 2/3 of the of the mix, and then 1/3 of earnings per share method as I blend these two prices. And I get to that 3% discount on Hewlett Packard. All right, so let's take Hewlett Packard through my process. Do I want to be part owner in this company? I really like the company, so the answer is yes, and I think it's a good industry. Is the company operated well? No, not at the current time. I think they had multiple misses on their earnings release. They missed on revenue. They guided higher. They missed on earnings per share. The free cash flow, they missed on that guidance. So that's three misses in one earnings. So I can't give the management team a check mark there. The debt is under 3x EBITDA, and there's no discount on the stock. So I'm a holder of Hewlett Packard. I like the company. I think they're going to bounce back, but for now, I'm not going to buy additional shares. Looking at where the stock has been over the last year, you can see that the stock got down to about $25 a share, and it went up as high as about $32, $33 a share, which was a nice rise. They were actually doing about 15% before that big drop, but I estimated that they're going to be year to date after the big drop tonight. They'll be at 6.5% year to date gain, and they are going to be paying a 3.75% dividend after the stock drops down to $28 a share. So the stock did present an opportunity to buy it at a lower rate, but I think for at least a quarter, investors are going to be a little skeptical about Hewlett Packard. That's a pretty big drop of 10%. Those are a couple misses on an earnings. So Hewlett Packard will have the right to ship and really be accurate on their earnings and their guidance. So again, Hewlett Packard's a quality company. They've been around for a long time, and I expect they're going to bounce back. They're going to right the ship, and they're going to have better days ahead. But they're going to have to get to work. They're going to have to get to work and have a couple of good quarters and really show investors that they're back. So I'm certainly hoping for that, because this is one of the great companies in our economy, and I certainly want them to bounce back. So that's my video on Hewlett Packard. My name is Victor, and I like sharing my analysis on YouTube. Please like my video and subscribe to my channel. I'd really appreciate that. With that, let me wish you the best of success in investing in 2023.